There's no denying that Nvidia has been doing super well recently. Just 2 weeks ago, it surpassed Microsoft to become the world's most valuable company before crashing back down to 3rd place, with Nvidia giving almost 200% returns over the past 1 year, while single-handedly contributing over 30% of the returns to the S&P 500 year to date. It has earned the nickname of the Magnificent One. Naturally, the question that many of us are wondering now is, how high can Nvidia go? Is it too late to buy Nvidia now? Or what should you do if you're holding the stock now? Should you continue to hold? Or should you sell now and buy back later at a cheaper price? And that's what I'm going to try to answer in this video. But before I start, do join my 9,000 members Telegram chat group to discuss or ask any questions that you might have. Despite the huge run-up, many analysts are still optimistic about Nvidia. On Seeking Alpha, Wall Street analysts have an average rating of strong buy, with the number of buy recommendations gradually increasing over these past few months. But how overvalued is the stock right now? For this, we can first check out its current PE ratio, which is currently sitting at 74. Okay, while the PE ratio seems high, given the cyclical nature of this company, Nvidia has seen much higher PE ratios in the past. In fact, the current number is actually around its 5-year average of 79. Though some people may point out that the PE ratio may not be suitable, since Nvidia today is a totally different company from the Nvidia 2 to 3 years ago. Instead, it is better to look at its forward PE ratio. So if we use the estimated earnings for the next 1 year, the latest forward PE ratio is at 49, which again is slightly on the high side when compared to past forward PE ratios. Then what about the forward PEG ratio, which just takes the PE ratio divided by the expected growth rate of the earnings per share? It is currently at 1.45, which again shows that the stock is a little overvalued. While all these numbers are quick and easy ways to find out whether the stock is overvalued or undervalued, a more thorough way to value Nvidia is to do a discounted cash flow valuation. And tada! Here it is. Okay, I know it looks complicated, but essentially, what I'm doing here is to project what is Nvidia's free cash flow 10 years into the future, then discount all that back into the present value. And from there, I can then calculate its intrinsic value. In order to do that, I'll first need to estimate the growth rate of its free cash flow. So what I did was to go to a few websites to find projections of the earnings per share. For example, FinRisk estimated that Nvidia EPS will grow at 46.35% over the next 5 years, Guru Focus at 46.36%, and so on. So for the bull case scenario, I used the most optimistic number of 46.36% for the next 5 years. After that, I assumed that the growth rate would slow down to 20% for the next 4 years. Using a discounted rate of 11.95%, which I calculated based on Nvidia's current financial numbers, I arrived at the intrinsic value of $126, which is actually pretty close to the current share price. But of course, it may not turn out the way we expected. So for the bear case scenario, we can use some less optimistic numbers, which is 31.57% for the next 5 years, then 15% for the next 4 years, and we arrive at just $67. Now, of course, I'm not saying that Nvidia will jib and crash to $67 soon. As the Dean of Valuation, Professor Damodaran puts it, Nvidia is the perfect momentum company. It has a great story, a CEO which sticks to the story, unlike Tesla, no distractions, is able to meet expectations of the short term because they have set the game out, and you have got a market that contributes to the mix. So as long as they can deliver high growth rates quarter after quarter, it can definitely sustain this kind of high prices. And this is all thanks to the new AI wave. Nvidia's revenue has increased almost 5x, earnings per share has increased dramatically, free cash flow shot up, while its operating margin and gross margin went up by almost 60% and 75% respectively. Literally, it's to the moon for now. Quick pause. If you're always on the lookout for the next best stock idea, you can check out Alpha Picks by Seeking Alpha. Alpha Picks is a stock recommendation tool designed to help you build a market-beating portfolio. Their expert team conducts in-depth quantitative, data-driven research and analysis to ensure their stock picks are poised for long-term success. Seeking Alpha's strong buy quant rating comes from powerful computer processing and expert quantamental analysis. From nearly all US equities, its quant algorithm picks stocks with the strongest collective traits, such as value, growth, profitability, EPS revisions, and price momentum metrics versus the peer sector. Every month, AlphaPix sends you 2 strong buy recommendations to buy and hold, sell alerts when ratings shift, and transparent up-to-date performance. The AlphaPix portfolio was able to give a 123% return, which significantly outperformed the S&P 500 since its inception back in July 2022. So if you are interested, you can sign up with my link to try out AlphaPix and enjoy a 1-month free premium subscription of Seeking Alpha, priced at $449 for the first year. Thank you to Seeking Alpha, who is also our partner and sponsor of this video. With that being said, let's get back to the video. But the question is, how long will this party last? Some people may draw parallel to Cisco, which, much like Nvidia, was the leader in providing infrastructure equipment used to power the internet back in the late 1990s. As a result, Cisco's stock price soared and later crashed during the dot-com bubble. However, this is not the case with Nvidia, as its current stock price is well supported by its fundamentals, while Cisco's stock price went far ahead of its fundamentals. So then, what is Nvidia's real risk? It is competition catching up to it. This is not a matter of if, but when. Currently, Nvidia has a whopping 94% market share in data center GPU segment, with almost every big tech company buying chips from them. And with so much money to be earned here, you can bet that many companies will try to come and eat up their share. For example, Google is developing their own chips. Microsoft is doing the same. Amazon, Meta, and even Apple has joined in the race. Not to mention a few of the other existing chip makers like AMD and Intel are also trying to catch up. Nvidia knows this well. In a latest report, they wrote, if we estimate our customers' future demand for our products, or if customers cancel or defer orders or choose to purchase from our competitors, we may not be able to reduce our inventory or other contractual purchase commitments. All of these factors may negatively impact our gross margins and financial results. That's why, while they are already designing chips 3 years into the future, they are not planning to rely on just selling hardware, but instead provide an entire suite of offerings, from system software to acceleration libraries to application frameworks. For example, Nvidia has NIMs, or essentially microservices, which helps companies develop their AI capability at a super low cost of just $4,500 per GPU per year, or $1 per GPU per hour. Then they have the Omniverse, which lets artists, designers, and developers collaborate, simulate, and even train AIs. Though currently, the revenue from software and services offerings is only expected to reach an annualized run rate of $1 billion by year end, which will be less than 1% of the total revenue if Nvidia manages to continue their current growth. However, from what we learned from many other companies, software subscriptions are a much more reliable way to grow their earnings. For example, ever since Microsoft switched to the subscription model in 2015, they have been steadily growing their revenue. Likewise, while Apple hardware sales growth have been rather flat, whether it's iPhone, wearables, Mac, and iPad, instead, it's their services revenue which has been growing steadily. So for Nvidia, while the main bulk of the revenue currently comes from selling hardware for data centers, software revenues will eventually go up. According to Nvidia, they are currently expecting their data center systems to grow to $300 billion, which is about 3.75 times the current annual revenue. While that is impressive by itself, what's more impressive is that they are expecting another $300 billion to come from the Omniverse and AI enterprise and cloud services. Will that happen? Maybe, maybe not. So let's do a quick and dirty math to see where Nvidia could be by 2030. Let's start with the GPU market first. Motley Fool estimates the GPU market to reach $400 billion in 2032, whereas another report estimates $271 billion by 2030. So let's just use the average number of $310 billion for the GPU market. Then let's say Nvidia market share has dropped from 90% down to just 50%. So there's $155 billion in revenue. Next, recall that Nvidia has a $300 billion opportunity for their AI software. Assuming that they are able to reach 1/3 of that, that will be another $100 billion in revenue. Same for autonomous machines, which is another $300 billion in market opportunities. Again, let's say Nvidia has 1/3 of that share, so there is $100 billion in revenue. Lastly, there's $100 billion for gaming. Nvidia currently has about $2.6 billion in quarterly revenue for gaming, or about $10.4 billion annual revenue. Let's just say Nvidia managed to grow this to $50 billion by 2030, or about half the market share. So in total, Nvidia will have about $405 billion total revenue by 2030. Nvidia's current margin is over 50%, though I would say that it is super high. But since Nvidia's software segment is expected to be as big as its hardware segment, let's just assume Nvidia has a 36% profit margin, which means their net income would be $145.8 billion by 2030. Now, let's use a conservative 25 PE ratio. That will bring us to $3.65 trillion by 2030. Turns out that Nvidia only has a 2% CAGR. Now, before the Nvidia bulls comes after me with a pitchfork, let's just remember that this is a very conservative estimate. Other analysts have even estimated that Nvidia could reach a $10 trillion market cap by 2030, basically implying a 20% CAGR for the next 6 years. So it mostly depends on what your estimates are. If you think Nvidia can continue to outperform, great! $10 trillion by 2030 is definitely possible. Otherwise, it may look ugly. So if you are thinking of investing in Nvidia now, what should you do? Now, of course, that's your money. So you should decide for yourself how you want to invest it. But here's what I would do for my own money. Based on my past lessons with Tesla, I learned that I should never FOMO into stocks, especially hot, overvalued stocks which are being overbought. Instead, a better strategy is to slowly dollar cost average in during market dips. The more I can buy at or below its intrinsic value, the better. Otherwise, I would rather look for opportunities elsewhere because Nvidia isn't the only AI stock out there, yeah. But what if you are already invested in Nvidia? Should you take profit now? Again, it's your own money, so it's up to you. But I will say that it's never wrong to lock in some profits every now and then. Heck, even the amount of Nvidia insider sell volume has increased recently. So that was a quick analysis of Nvidia. But do let me know what you think. Are you bullish or bearish about Nvidia now? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.